let's bring on board the management of Cyient DLM in a short while from now. But let's also remember the fact that the IPO will be opening today for subscription that is Cyient DLM IPO that is opening for subscription today. And let's go across to the management. We have Mr. Krishna, who's the chairman, non-executive and non-independent director, Cyient DLM, joining us on the show. Very good morning to you, sir. Thank you so much for joining us on ET Now. And firstly, let me ask you about your IPO, and also we want to understand the reason for the IPO size reduction. Is this because of the investor feedback was such, or the business requirement has changed now?
So the IPO size was cut down from 740 crores to 700 crores, of which, and then Amansa took a pre-placement of approximately 108 crores. That's why the IPO size shows up as 592, but the IPO size is 700 crores. So it was a slight reduction. We were just looking at some of the capital requirements and how we can deploy the capital. We took some feedback from the market in terms of what is the right number for us, and we triangulated to that number. So if you look at it, it is a reduction, but not a very large reduction. It's less than a 5% reduction. It's just that's how it worked out based on how we thought we could deploy funds effectively, quickly, because we are also responsible for deploying funds as we say we will. Therefore, we took that call to say it's better to take a smaller number rather than a larger number at this point.
Good morning, sir. This is Vinny joining in the conversation as well. What we also wanted to understand, even if we look, at the stock valuation, it's very close to the average of the peers, or in fact, a little cheaper than that. Despite you having ambitious targets of 5 times in 5 years, why is that?
Not really. I mean, I think we had some very good bankers who helped us arrive at a fair valuation. And Cyient as a promoter also agreed, or the board of Cyient as a promoter also agreed that that was a fair valuation. Obviously, I think we're very cognizant that the value or the valuation follows the value that we deliver. So we're quite confident about the value that we will deliver the next few years, and therefore valuation will be an outcome of that. So I think that's the fair way to do this, rather than do it on a hypothesis or on any euphoria. Therefore, we thought this was the fair value, and I think that's something that the Cyient board also strongly agreed with.
Right. The industry growth rate is approximately 30 to 40%, but yours has been actually languishing around the early teens level. Are you expecting that to catch up to the industry average, at least, if not better?
Absolutely. I think the previous year was, I think, roughly 15%. And there's a few reasons for that, including the fact that we were more focused on margins. Margins are now at approximately 11%. Last year, they were a little bit higher even. This year, we made some investments which brought it down to 11%. So growth was 15% last year. But going forward, will be aligned to the industry growth rate. I don't think we said the growth rate would be single digit at any point going forward. We're quite confident that going forward, the growth rate will be aligned at least to the industry. And if you look at our order book, which is approximately 2,500 crores on an 850 crore or so revenue base, that also bodes to the fact that there is some good growth ahead, and we're talking based on an order book rather than anything else.
So let's then talk about the order book. Where's that growth coming from? Which segment is seeing the maximum traction?
So the order book is still quite concentrated on the electronic manufacturing. That's where our biggest value proposition is. And that's where we also make some of the best margins and have the best stickiness to the customer, because that's the kind of electronic manufacturing that we do is very high precision. And therefore, it's built on some very unique capabilities, both in manufacturing, but also in special processes, finishing, etc. So much of the order book is really building up in aerospace, defense, and industrial. The fourth vertical that we're also focused on, medical, also has a strong order book. So while while aerospace and defense is a large part right now, we believe that going forward it will even out a little bit based on how the order book is building up.
Right. The street actually was a bit worried about the client matrix, whether the reduction on the client's front or the high concentration. If you could elaborate more on that, what's your take on that particular front?
So if you look at the top 10 customers, there's five that we've mentioned. Or there's five key clients, not all, I think four of them are top 10. But if you look at our top 10 customers, they're some of the largest manufacturing innovators in the world. The amount of money that they spend in areas of interest to us are in the billions of dollars each. So the market share that we have with our key clients is quite small right now, and that is really the immediate opportunity, and that's where we're seeing the immediate growth also coming, is because how these key clients will shape up. So in that context, we are very confident that the client concentration is not a problem because, again, like I said, these are the largest manufacturing innovators in the world, and if these companies stop spending on manufacturing, then there's a much bigger macro challenge than just Cyient DLM being impacted.
So, you have spoken about the gross margin outlook, but could you help us a bit more with the timeline from current 11%? When does it see it improving to the 13 to 15% mark?
So this year, of course, there was a drop because from roughly 12% to roughly 11%, because if you look at it, the drop didn't come from gross margin, it came from sort of between gross and EBIT or EBITDA. The reason for that is we've made a number of investments, both in terms of the leadership team, but also in terms of the sales team. We've made a lot of investments on supply chain and on technology. So as growth happens and as we see the growth happening, the absorption will take care of a lot of that. And therefore, this year we might still be about flattish with margins, with where, with again, the investments still continuing for the year. But going forward, we believe that we have a clear line of sight to 13 to 15% EBITDA margins.
Right, and since you are with us, let's actually talk about Cyient as well. You recently completed the CITIC acquisition. If you could tell us, net is Q1 trending similar to Q4 or better or worse? What's your outlook on that particular front?
So I would say the net is flattish because there are industries where it is better. If you look at industries like aerospace, which have come back very, very strongly. There are industries like energy, where our solutions, our services are quite unique. Again, we're seeing some very, very strong demand. But on the flip side, there are also industries like communications, where the demand is a little bit weaker because a lot of their spend is capex related, and with where the interest rates, etc., are, there is a bit of a lull on the capex cycles. So I'd say in industries like communications, where our customers borrow and then invest in capex, there is a bit of a lull because I think the interest rates and where things are doesn't support that. But where our clients, which is again a majority, where our clients do their own R&D, I would say if anything, things are getting better. So if I take a weighted average, I would say about the same, maybe slightly with a positive bias, I guess, I'd say, in the financial industry.
All right, Mr. Krishna, we'll leave it there. Thank you so much for joining us on ET Now, and also all the best for your IPO, which has opened for subscription today, and also thereafter for the listing. And that was the management of Cyient DLM talking about how they plan to use their IPO proceeds. And also remember, they've said that they're quite confident that they were able to deliver value to their shareholders. Also confident that the growth rate will align to industry average of about 30 to 40%. But let's